Today is Friday, February 7th, 2020. Institutions continue to support key technical levels. And this is your 2-minute drill. Hi, I'm Jonathan Gurney, Portfolio Manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what is happening in the stock market. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use fundamentals primarily and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. A friendly reminder, this video is not to be taken as financial advice. Should you have questions, feel free to reach out to us through email or social media comment section. We just released a new website at gurneyfinancial.com. This will be very helpful. If you have any questions or have questions in reference to our philosophy, check out the FAQ section. We are going to transition into the charts to see how the day closed. Take a look at performance on the week, and we will transition there right now. Okay, so here's a look at the index on the day first. So today closed a little bit down. Again, this is really important for many clients to understand. If I think it's more than a 2 to 3 day pullback period, I will sell, but I do not think that this is going to be that. I will watch price action, but we are testing key levels. And if I, sell today, I got to wait at least a day to get back in, and that causes some issues. So a little pullback, but after a fantastic week. So this is just Friday. So I'll show you the levels we're testing and so on in a second. So not the best, a mild day down, but look at the week. Yes, that is a fantastic week with the S&P 500 up 3.17%. The NASDAQ and the leadership continually showing strength. The laggard, the Dow, and the Russell 2000, which has been a consistent theme. Now let's shift over to the sector performance. This is for the day, so don't forget about that. It was, again, the day was relatively ugly. What performed the best today? Risk off assets, consumer staples, which, risk off assets include consumer staples, real estate. Communications actually did pretty well, which is not a risk off asset. It's a risk on asset. Financial sector is kind of a tweener. Utilities is definitely a risk off, but it has been a huge outperformer recently, so it's just taking a breather. Nonetheless, kind of an interesting day. Nothing really. We traded in a range all day today, so it was kind of a boring day, to be honest with you. 1 week performance. Let leaders be leaders. Hello, technology. There's a reason why we have a huge portion of the assets invested in this sector. You got to be careful at times, and this is honestly probably one of them. But the week was fantastic after a horrible last Friday. So keep that in mind. Last week we were showing you, hey, the coronavirus we had a Friday sell-off, and people were expecting the worst coming Monday because the Chinese market was closed for an entire week. However, on Monday, the Chinese index was down over 8%, and since then has rallied significantly, which honestly I think is giving us a little bit of boost across the indexes. So kind of interesting. Risk on this week did quite well. I mean, these were basically the industries that you want to see do well during a bull market. This is exactly what you want to see. Risk off did poorly this week. So kind of interesting. We're going to switch to price action now, do a little monologue there, and then we'll hit the 2-minute drill. So thanks for your patience. So this is the S&P 500. This is showing a 6-month perspective. And so it's not exactly long-term, but it goes out long enough to kind of show different moves. We've been since October on a fantastic rally. You're seeing how closely it stayed above the purple line, the 10-day moving average, which I believe is an important indicator because institutions, if they support that level, tends to be a good time for the market. Last Friday, we saw our first significant test all of basically last week. Here's the big test of the 50-day moving average. We quickly bounced back on Monday. We had a gap up, which I said, be careful. This will probably be tested soon. We gapped up all week. Monday, Tuesday, Wednesday, Thursday, Friday, we gapped down. Actually, I shouldn't even say gap down. It traded down. It was not a horrible day. We are currently testing the 33.13 to 33.34. So it's a tight range that we're testing. The day closed at 33.27. Not a lot of movement today. So these are normal dips. It's going to happen. It's been really good price action, to be frank with you. I'm a little surprised the coronavirus did not cause a little bit more of a dip. That's how strong of a market we're in right now. I wish I would have added more at that point. We did time this exceptionally well on selling at 33.30. We said the wall, that was the name of the title of the episode. We sold at 33.30, tested down. Wish I would have bought more, but I think we're going to get another test shortly, potentially to this red area, which is the 32.75 to 32.50. We'll see. I'd be happy to see a test of the 10-day moving average of the 32.85, but we'll see. Right now, the price action has been very good. If you are too bullish or bearish during this time, this is not a good idea. You want to have an open mind on periods such as this, because there are some legitimate concerns. However, the price action from a technical standpoint has been very, very good. Institutions have bought at key levels. I mean, look how quick this hit and we bounced up on a 4-day. That's nuts. I mean, you take out the coronavirus, this is on a consistent path higher here. These are healthy tests. Again, not to be a broken record, but you're going to see dips of 3, 5, 7, 10%. None of those mean there's a recession. In fact, we saw one in 2018 of 20%. Financials were actually pretty good. That was a Fed impacted time. So understand that we believe that there are a few things that impact the market, and the Fed is definitely one of the biggest impactors. One of the biggest issues to really pay attention to. So keep that in mind. We're going to hit the next chart now. Start the 2-minute drill. Here we go. So that's the S&P 500. Momentum and growth. This is something we've been watching. The correlation here. Value recently has had a nice move higher over the last 7 months. Growth, momentum has played catch up here. So we're either going to probably trade sideways for a little bit here, maybe go down. But leadership will likely continue, in my opinion, in the momentum growth areas. You got to understand this rally has mainly come from about 10 huge large cap companies. So there are actually a lot of really good setups right now after a little bit of a pullback. So we'll see what happens next week. Next week will be very interesting. But that is momentum versus value. Momentum is the green line. We're going to shift to put call ratio. We consistently have been saying when you see a put call ratio in this range, be a little cautious. There's a little complacency. It's not horrible. There are truthfully mixed signals right now, and it's very difficult to say which way is this going to go. So you don't do anything stupid. You watch key levels to see if they hold, and that is how we've done well and beat the market over the last 2.5 years. So nothing, in my opinion, that needs a ton of changing. Right now, we sit about 65% invested, about 55% in higher risk, and that has done exceptionally well, and about 10% in more bond-related risk-off area, which actually did exceptionally well during the 3% dip that we had. So we still have a lot of cash, and we're looking to deploy soon, but not sure it's the right time quite yet. The VIX, we said, hey, when we get to these areas between 14 and 10, stupid stuff is going to scare the market. We're actually in a good range here. Good things tend to happen when we're in this range. It's good to know the market is real. I would be cautious because the VIX is holding the 200-day moving average. So yes, the bulls had a nice run, but bears could still take this. So be careful here. The 200-day moving average right there. This is where I'm saying there's a lot of mixed signals that I'm watching very closely and take seriously. The amount of cash is also very interesting. So on one hand, we're saying there's some complacency, but of active managers, only 62% is currently invested. So 38-ish, 37-ish percent is currently in cash, which is, it could make this for an extended rally. And we've shown this chart, and not to be a broken record, but when you have a period, this is the S&P 500, where you have 1.5 years of consolidation, sideways movement, it tends to lead to good things. And if this is anywhere near the performance of this, it's going to be much, much higher than where we currently are. So keep that in mind. We hope this helps. It's kind of interesting. You're seeing that there are a lot of mixed signals, and we believe it's too early to sell more, and it could be potentially a time to buy shortly. The bull bear, we said when the bulls got a little extended here, we did sell, which was when we sold at 33.30. It has recently backed off. Level of bears has increased. So you're seeing some mixed signals here. Active managers are backing off a little bit, but there's still some signals pushing that could push us higher. So that's where I'm saying I don't want to do anything too obnoxious here. I will close with this. I'm going to read you something that I put together this morning. So it's based on yesterday's close. For those that are saying the following, the 1-year return for the S&P 500 is 22.48%. We are due for dip. That is not a reason to sell. I want to explain that time frame is everything. So if we take a quick look, the S&P 500 1-year return is, like I said, 22.48%. Since December low, December 24, 2018, when we saw a 20% dip, that was the low point. I was screaming to clients, buy, buy, buy. Had you done that, you would be up over 42.58%. That's how we've beat the market. That's how we've done well. You buy those dips. That was the day before Christmas. It was absolutely nuts. But since the October 2018 highs, we are only 13.77% higher. So on one hand, you're going to see, look how great the year's been. But guys, that was coming off of a 20% dip. So we are only 13.77% higher over a 1.2 year period. That is pretty in line with where performance usually averages. The market usually averages between 8 to 10% depending on dividends. This is not anything outrageous. Evaluations are not outrageous. There are some companies that I do think are overbought. The Tesla, when it hit close to 1,000 quickly, I'm like, sell like crazy. But now it's getting to a point where it might be a buy again. So don't just assume the market's going down because we're at all-time highs. Had you thought that throughout all of time, you would never make any money. So keep that in mind. So we appreciate your trust. I hope this message helps. We hope that you can appreciate some of the messages that we put out. In one more thing, at our website, if you visit it, if you want to pay attention to the stuff we put out, you miss it, you don't know where to find it, you go to our website, go to the blog section, and here you will see the most updated video. It's obviously not up there yet, but it will be. And I highly recommend you check out the blog. Occasionally, like once a week, we'll put out an actual blog. So there's two sections, the vlog and the blog. The blog gave you a last weekend update of what we thought about the coronavirus, whether it was going to have a huge impact. I'm surprised it honestly didn't have a little bit more, and it still could. There are still some concerns there, but we basically said there in summary that there's opportunity when you buy those dips. So in short, let it be a resource to you. If you want immediate access to this stuff, if you subscribe, it'll be sent to your phone and you'll be updated when this stuff comes up. Completely up to you, no pressure whatsoever, but you have resources. We hope they're helpful. We hope the color commentary with these messages are helpful. Let us know if you have questions. Have a good rest of the day. Bye.